we are expecting an extraordinary increase in demand for these elements as the transition to electric mobility and the transition to sort of green renewables begins to gain pace in the early 2020s.
Welcome viewers to this market outlook on rare earth elements that forms part of One-to-One Mining Investment Africa. Presenting for us today, I'm pleased to introduce George Heppel, who's Senior Analyst and Expert in base battery and the broader technology metals complex for CRU. George, great to have you back with us again. Today you're providing us with an outlook on rare earths, which have entered an interesting time. Again, I think it's fair to say that. So please take us through your analysis.
Absolutely. Thanks for having me again, Adam. Let me just quickly share my screen and then we can get started. So as discussed, Adam, the purpose of the presentation today is to talk about rare earths, and I want to talk about a specific part of rare earths. There are a lot of really interesting facets to rare earths at the moment. You've got the obviously you've got the very large price increases in the spot market in China we're seeing at the moment. You've also got the sort of long-term demand trends as well, and there's also a lot of discussion around sort of cost analysis of the market as well. I want to focus on just one particular small part of the market, which is the basket problem. And the reason why is because I think it's going to be a very key driver of sort of valuation of rare earth assets in the future. And I think it's if you're sort of new to the rare earth industry, I think this is definitely one of the first things that you need to sort of think about quite carefully. So let's cover a hypothetical situation. Let's say that you are the strategic manager of a mine that is the sole global producer of two products, and you're the only mine in the world that produces these two products. You've got phosphite, which is a sort of industrial material used for making steel, and you've got cavorite, which is a sort of up-and-coming technology metal, handful of small end uses, and you produce these two metals in equal quantities. The two elements are fused together within the ore body as standard, and therefore you can't sort of preferentially mine one or the other. They both come out of the same operation. And one day you're reading the news and you're reading the Daily Miner, and you see news flash: cavorite essential for fusion technology. Some other big increase in demand for cavorite specifically. And obviously, once you stop celebrating, because you are obviously the only producer of cavorite in the world, you begin to come up with a plan. And essentially, this means that demand for cavorite is going to increase quite dramatically, but demand for phosphite is obviously going to remain constant because phosphite is unaffected by this change in demand. So what do you do? Ultimately, you've got two choices. Either you boost supply to meet the newfound demand for cavorite, and that means that you gain a lot of extra revenue from the cavorite market, but then you're probably going to plunge the market for phosphite into massive oversupply, and you're going to tank prices for phosphite because you can't just mine cavorite, right? They both come out of the same mine. The alternative is that you just steer the course, keep everything steady, and you have that preserves the value of the phosphite market, but you miss out on huge amounts of demand for cavorite, and that might be partially balanced out by an increase in price. But if prices for cavorite remain too high for too long, then people might find substitutes. People might find a way to live without it. And what's the answer to this problem? Well, generally speaking, the answer is number one, although it is a little bit difficult to discuss. But I think the point of this example is to illustrate the basket problem. And the basket problem is something that we see across a few different commodities, but it's going to be a major issue for rare earths going forward. So before we get started, let's talk about rare earths in general. Rare earths make up 17 elements, 15 and then 17 if you include yttrium and scandium. I haven't got scandium on this table here, but perhaps I should, given the fact it's been in the news recently. But scandium is kind of separate because it's not really found. It's kind of extracted in different ways. Anyway, the point is that you've got lanthanum and cerium, which are the lightest rare earths. They make up about 65% of the total market by volume, and they're used for their sort of standard industrial metals. They're used for making steels and alloy manufacturing, and they're quite good for sort of support beds for catalysts and that kind of thing. The second big group you have is magnetic rare earths, which are neodymium and praseodymium. And again, by volume, they make up about 25% of the market, and they're used anywhere you need a high power rare earth magnets, so portable devices, and most importantly, electric vehicle motors and wind turbines. We'll come on to that later. Obviously, a major source of demand growth in the future. Finally, you have the heavy rare earths, which make up about 10 to 15% of the total market, but most of that's going to be yttrium. And they're used in small quantities for a wide variety of different applications, military applications, technological applications, semiconductor dopants, and all those kind of interesting things. But the point is that the vast majority of rare earths is just 4 elements, right? By quantity. It's lanthanum, cerium, which are the industrial rare earths, and you've got neodymium, praseodymium, which are the sort of magnetic rare earths, which are most important for sort of new technologies. And I think just to illustrate the breakdown of sort of where rare earths go, and for this we're talking about rare earths as a whole, we're talking about the entire market, but you can see this is broken down by market volume. You can see that permanent magnets make up about 25–30% of rare earth demand by tonnage, and that's most neodymium and praseodymium demand. And then you also have a bit of demand for stuff like samarium and dysprosium and that kind of thing. But in terms of revenue, permanent magnets may go up 2/3 of the entire rare earth market. And you can see how important the permanent magnet market is for rare earths as a whole. And that's only increasing over time. So let's get into the problem. Well, actually, no, before we get into the problem, let's just talk about the 2 main drivers of magnetic demand, and that is electric vehicles and wind turbines. Electric vehicles, I think, the growth potential for electric vehicles is pretty established right now. I don't think there are many people who doubt, the way that electric, the transition to e-mobility is going to transform the world over the next couple of decades. But as you can see, we have, CRU is often seen as being a relatively sort of conservative voice in the market at times, but I mean, even we have 70% xEVs by 2040, and that has massive implications for commodity demand, especially rare earths, and that's because rare earths are needed for electric motor systems. There are 2 different designs. Without getting too technical, there are 2 different broad sort of designs of motor. You have induction motors and synchronous motors. Induction motors contain no rare earths, and synchronous motors contain rare earths. And induction motors are not really used much anymore in the electric vehicle sector. They used to be championed by Tesla, of all people. Tesla uses induction motors in their Tesla Roadster, the Model S, and the Model X. But from Model 3 onwards, Tesla is using synchronous motor designs which contain rare earths. And the reason for that is that they're more efficient. They leave you exposed to another commodity market, which at times has been volatile, but they are significantly more efficient, which increases the range of your vehicle. Secondly, you have wind turbines as well. And obviously the specific technology for wind turbines, again, in a similar way, you have sort of magnetic and non-magnetic designs for electric for wind turbines. And that will vary depending on whether you're looking at offshore and onshore, because for offshore placements, you generally want a more sort of reliable technology. So rare earth magnet technology is generally used much more for offshore rather than onshore. But it still stands that we are expecting the vast majority of wind turbine placements to contain rare earths, because the rare earths make them more efficient. And as a result, we have very strong demand expectations for electric vehicles. And I'm just talking about lanthanum, cerium, praseodymium, and neodymium for now. But you can see on the right-hand side, we're expecting lanthanum and cerium demands to broadly follow GDP over the next sort of 10 years, sort of broad global economic growth. Although we could see a little bit of decoupling between commodity demand growth and GDP, depending on the sort of developments of kind of recycling and the sort of idea of a circular economy. The point is that we have sort of pretty modest growth of lanthanum and cerium. Neodymium and praseodymium, on the other hand, from our benchmark of 2008, you can see that we're expecting demand to be, annual demand to be 3 times higher for these elements in 2030. We are expecting an extraordinary increase in demand for these elements as the transition to electric mobility and the transition to sort of green renewables begins to gain pace in the early 2020s. You can see we saw a slight dip in 2020 as a result of COVID-19, but we're expecting that to be the exception and not the rule. And this is reflected in their price. You can see quite clearly. Just one thing to point out in that chart on the top right hand side, I've actually had to use a logarithmic scale for the price, just purely because of the ridiculous thing that happened to the price in 2011 during the rare earths crisis with the Senkaku boat incident and that kind of thing. As you can see, prices for all four elements were 10 times higher in 2011 than they were sort of pre then, so like 2009, 2008. That's pretty standard. Everyone knows that part of the story. The really interesting thing is that when prices sank after that level, magnetic rare earths actually reached a sort of a plateau below, above where they were historically. So magnetic rare earths have remained relatively stable in real terms at around three and a half times higher than they were in 2008. And compare that with cerium and lanthanum. Cerium and lanthanum prices are around a fifth of levels that they were in 2008 in real terms. And this is reflected in the relative splits of revenue for an average mine. I mean, what I've shown here is kind of like an average mine, like an average of all the sort of deposits that we cover. But you can see that before around 2011, cerium and lanthanum industrial rare earths made up about half of all revenue at these mines. Fast forward to today, and it's less than 10%. The vast majority of revenue for these mines is now based around neodymium and praseodymium. And that's because, as we said, this is the basket problem illustrated. I'm not saying that there's, the basket problem, we were only talking about one mine, which controls the entire world supply of two elements. In this case, it's, 10, 15 mines illustrated here, but they all have a reasonably similar, within a certain range, they all have a sort of reasonably similar sort of distribution of elements. There are a couple of outliers, obviously, but as a general rule, around 2/3 of the mine deposit is cerium and lanthanum, around a quarter is neodymium, praseodymium, and then the rest is just sort of heavies and that kind of thing. And the point is that we've been expanding supply in order to meet that neodymium and praseodymium demand. And the result is that we've seen a ridiculous oversupply of other elements like lanthanum and cerium, because it's impossible to balance that impact. And as a result, that's why we see lanthanum and cerium prices at a fifth of normal levels. So what can we take away from this? I think the first lesson is that not all projects are made equal. I think the exact ore body makeup can, it can vary widely from asset to asset, as you can see on the right hand side. And ultimately, I don't think it's just a case of sort of picking anything which has neodymium and praseodymium in it. I think there needs to be very careful considerations about the cost structure of your asset based on sort of reasonable expectations for cerium and lanthanum. And before you ask, I can't tell you what mine E is. And whenever I present this presentation, everyone's always asking, well, what's the one which is like 40%, 35% magnetics and only 50% industrials? I'm afraid I can't reveal that data. But if you are interested, please do get in touch, because we've been doing a lot of modeling on this sector. And I think another important thing is, think about this in the long run. Cerium and lanthanum, they may end up getting so oversupplied that we may end up classing them as gangu material. They may be stuff that we just need to leave in tailings, or we just need to leave them in tailings, or we need to extract them and dispose of them. And if that happens, if the price falls to that level, how is your chosen asset going to dispose of these materials? I think that is an important thing to bear in mind. I think you can't just take a historic price and then just extrapolate it forward for cerium and lanthanum and just be like, oh, they're industrial elements, they'll always be needed for something, we'll just put in, when we're building our discounted cash flow model, we'll just shove in some credits for them and then I'll be okay. It's an important thing that you need to sort of bear in mind. I mean, I often think about sort of lead zinc mines. 50 years ago, obviously, having a lead zinc mine, you'd have a reasonable fraction of revenue coming from your lead sales. Fast forward to today, and it's almost a deleterious element in a lot of ways. So how do you even cost rare earths anyway? I mean, I've been talking about sort of cost modeling and sort of, DCF modeling and that kind of thing, but it's hard enough to model a sector which has one byproduct, let alone potentially sort of 16. Obviously, traditional sort of cost modeling involving like pro rata or net byproduct calculations isn't really relevant for rare earths, because if you do if you're let's say you're building like a neodymium cost curve, if you do it with using a sort of a pro rata base, then the costs are going to look ridiculously high. And then if you do it using a sort of like net byproduct base, the costs are going to look ridiculously low. So there's, the way that we do it at CRU is we use margin curves. The margin curve is the way that we do it. And essentially what we do is we forecast the price for we build supply demand models for all of the, rare earths that we cover. And then we use those supply demand models to come up with sort of reasonably defensible price forecasts, not too far into the future, but reasonably defensible ones. And then what we do next is we use that to calculate, operational margins, and we build out like a marginal cost curve like this, like a margin curve like this. And then what we do is we flex the neodymium and praseodymium prices to understand, what price is needed to bring on what assets and that kind of thing. And that can give you a reasonable view of, bearing in mind sort of like returns needed on capex and that kind of thing. That gives you a reasonable sort of methodology for forecasting neodymium and praseodymium prices, which is becoming increasingly important, especially given the increase in demand that we have. So it is very fiddly, it is quite tricky, but the good news is it can be done. And you do come up with some very interesting results. I mean, on the left-hand side, that's our cost curve. And as you can see, the costs vary massively. The light blue assets are Chinese assets, and the dark blue assets are ex-China assets. And this is just for 2025. But as you can see, we have a couple of assets in our forecast model which have ridiculously high operating costs, but because they have much more favorable sort of ore bodies, they have much more favorable splits between sort of heavies and sort of medium rare earths and that kind of thing. They do actually end up being quite profitable. Anyway, you never normally see cost curves as sort of lumpy as this, so I find that quite amusing. In conclusion, the transition to a greener global economy is going to create huge demand for rare earths, but it's not going to apply to all of them. And in some ways, the increase in demand for certain elements is going to have a massively bad impact on other elements. A rising, we in commodities we often think, a rising tide lifts all boats. Demand for battery metals is going to go up because of electric vehicles. Demand for base metals is going to go up in response to increases in inflation or whatever. Rare earths is not that same sort of basket. It's not all rare earths are going to win as a result of the increase in the transition to e-mobility. And whenever you're sort of considering rare earth mining projects, this basket problem needs to be quite an important consideration. You need to give a reasonable assessment of byproduct credits from sort of maybe less favorable rare earths. You need to think maybe in extreme cases about how they're going to handle excess supply of these if no one wants them. And ultimately, you need to understand how to sort of model costs and sort of model revenues coming from these projects as well. So that's all I had. Thank you very much for listening. I hope it was interesting, and I'm very happy to take any questions via email or just via any sort of the normal channels.
Just thinking about from the mining company perspectives at the moment, obviously, and your point around, a rising tide, it's obviously an easier market. Equities markets looking more buoyant this year, whether it's to do with the pandemic or not. It's been reflected in a lot of junior companies' share prices. And it's perhaps easier to raise capital now, not exclusively for rare earths projects, but for most juniors. But how do you see the rare earth miners in the junior tier performing at the moment? And do you think with the recent interest in rare earths is going to actually bring in enough capital that they need to bring the capacity online. It's probably a sort of an ex-Chinese asset question.
Sure. I think there are a lot of unknowns. I think the key unknown for me right now when it comes to the rare earth story, especially from a junior mining perspective, is it's just about Chinese capacity, production capacity. I think that's one of the key things which is so difficult to forecast in rare earths compared to other commodities. Any other commodity, we've got a list of mining assets. We know their capacities. We know what their expansion plans are. But for rare earths, it's really difficult to say what the Chinese production quota is going to be like over the next 5 years. I think that's one of the key unknowns, really, that will determine sort of the level of investment ex-China. But ultimately, irrespective of whether or not that capacity increase comes from China or from projects outside of China, I think it is needed somewhere. And I think that will be reflected in the price. I mean, we are, our sort of, I can't speak too much about our sort of forward price views, but, investment in rare earths is sort of relatively unsustainable at current prices. Even the higher prices that we're seeing in the spot market today, I think prices will need to increase in order to see that level of investment. Where that investment flows will depend on geopolitical reasons. It will depend on sort of investor sentiment in different sort of projects. But I think it will have to come somewhere, as it were.
Yep. Tying that into some of the geopolitical aspects, you've got Australian government and US government sort of collaborating a bit more on rare earths within their broader critical minerals remits and acts that have come out last year or the year before. Do you think governmental support and even government providing capital for rare earth projects is realistic, or is it a form of capital that's going to expand currently?
It's such a tricky one because so certain rare earths are very, very critical from a sort of supply perspective because they're used in sort of military applications and that kind of thing. And I think my favorite quote is the F-35 fighter jet is basically a flying periodic table because it contains pretty much everything somewhere in the plane. But for me it's a bit of a leap to go from heavy rare earths are critical and we need to look after the supply of them to let's throw X 100 million behind a neodymium praseodymium mine. It's a bit of a tricky one, really. I think the main challenge for rare earths is just that the capex requirements are just so vast, so they're so complicated, such complicated operations compared to like a pure sort of lithium or a pure like copper cobalt project or something. That it's really difficult to say. Does the price of rare earths increase to the point where US and European auto firms are struggling to get material, and then governments step in and say we'll build sort of neodymium, praseodymium capacity outside of China? Maybe. I mean, my personal view is I think if supply did get that ridiculously tight, we'd probably see auto companies moving over to rare earth free technologies instead of relying too much on that. I think that's probably the more likely scenario. So yeah, in conclusion, it's a difficult one. I think it's important just to make the distinction between sort of the ultra critical sort of, and I'm talking like terbium and erbium and sort of lutetium and like ytterbium and that kind of thing, and the sort of magnetic rare earths like neodymium, praseodymium, which are more for the auto sector.
Certainly. Okay, that thing sort of opens up another point that I was thinking of around. It's almost sort of paradoxical scenario with regards to most technology or transition metals, and then rare earths within that is the capex, and then marrying that up with the ESG requirements that funds that are going to be willing to put into rare earth projects are going to need to see, and then marrying that up with the disposal of all of the excess material, the tailings, the expense of linking in, the refining process. How, as a mining company or in a chemical processing operation, can you have these environmental deliverables as well as these extreme capex costs? It's very much a challenge to get the end greener product, or the EVs that will represent most demand for these, the magnetic metals in particular. Do you see that being a huge burden that some companies won't be able to overcome, or it's going to require that government support to get over that?
It is difficult, isn't it? I mean, rare earths have a pretty terrible sort of environmental, reputation. I think we've all seen the sort of pictures that emerge from some of the sort of Inner Mongolia mines when it comes to sort of it's mainly a refinery issue. I would say it's a lot of it is sort of separating out those. It's very difficult to separate out those 17 elements without causing some degree of sort of environmental harm. That's not to say that it can't be done. It's just very challenging. I would say that there's no reason why rare earths cannot be extracted in an environmentally friendly manner. It's just going to have to come down to price and cost. Fundamentally, it doesn't have to be. It doesn't have to be sort of the way it has been historically. Anyway, that's all I can really say on it, to be honest, without sort of speculating too much.
Yeah, no, indeed, and I think it's a complex challenge inherent of the mining industry. Anyway, get your hands dirty to get a clean end product. That's metals.
Yeah, just another thing to say is just like, I mean, the beauty of rare earths is that they make cars more efficient. Like if you're designing, so rare earth motors containing rare earths, like synchronous motor designs, I think they're around, if memory serves me correct, I think it's about 15 to 20% more efficient than a traditional induction motor design. And what that means is that if you have two cars and you want them to go to the same range, and one's got a rare earth magnet motor in it and the other one's got an induction motor in it, the induction motor battery has to be 20% larger. So it's always going to be a bit of a toss-up, really. I mean, you get the, sure that you might have issues with sort of the environmental there might be some environmental issues with rare earths, but you're saving 20% on the size of your battery for the same amount of range. Yeah. So it's always going to be a toss-up. You always got to look at the whole life cycle of the car. It's a difficult one to do, really.
Yeah, hard to get the sort of full picture on the performance, but that life cycle view is certainly important when measuring it up, when weighing it up. Okay, that's great. Excellent. Well, that's covered everything I think I've wanted to ask, and thanks very much, George, for the update. It's a really good insight there into the basket case scenario for rare earth elements. So thanks very much.
My pleasure. Thanks for having me.